And I guess on the cusp of earnings season, and kind of focus on that, Lisa, in that stocks are discounting mechanisms. There has been multiple contraction due to rising interest rates. Is there more to go based on the E side of things, disappointing, or do you think that a lot of the lowered earnings expectations are already reflected in some of the big moves we've seen down?
Well, Joe, to your point, we are cautious coming into this earnings season. You've got a number of headwinds that companies have been facing, whether it's constrained labor and higher wages or supply constraints, as well as just ongoing uncertainties from the Russia-Ukraine situation and COVID lockdowns in China. So we expect that with that difficult type of uncertainty, that guidance may be more cautious. And ultimately, if you see some of those earnings reports really weaker than expected, I think to your point, we could really see what we call a second repricing. We've had the first repricing on the back of those multiples coming down. But again, there's a risk of that second repricing based on potentially lower earnings forecasts going forward.
Uma, are you in the soft landing or the hard landing camp right now?
Great to be here, Joe. And I think really at this point, a recession seems somewhat inevitable, right? So I'm not sure a soft landing is really in the books. The question really here is whether this turns what has really been a corporate-led type of a slowdown, whether that impacts the consumers in a bigger way. And that's really based on what we see with the jobs market, right? So far, so good, still really strong, but we're seeing the Fed now looking at even further tightening, more aggressive policy changes here. So if we see that labor market really start to weaken, that consumer feel even worse, that's where I think we're going to find a little bit more of an issue from that recessionary type of perspective.
So that's your forecast, that the Friday number is kind of a lagging number and that eventually you'll see some of the weakness in the labor picture, which we haven't seen yet?
I mean, a lot of what we're looking for, too, is, right, just the amount of job openings out there, what we're seeing from the JOLTS report, a lot of that comes on a pretty big lag. If the Fed is using that as well as inflation, both of those somewhat lagging indicators, and by the time that the Fed policies actually come into play in the economy in reality, it's going to be significantly further down the line.